Good afternoon, this is Bob Iacchino coming to you from the CME Group trading floor in Chicago. Talking equity futures, let's talk S&P 500 futures. Given we got 3 days up in a row, 4 weeks of the last 5 up on the S&P 500 now. Even the 1 week that was down was near unchanged. It was a very, very small little downdraft there. So the S&P seems to be pretty strong as of late. We've reached a level of almost 6% higher on the year. We just turned positive on the year on the S&P in May, and we've continued to build on that. So it's probably a good time, now that we're more than 3/4 of the way through the earnings season, to have a quick earnings scorecard. About 81% of the S&P 500 companies have reported, and earnings so far have been outstanding. According to FactSet.com, you've got about 80% of the companies reporting positive surprises on earnings per share, about 74% of the companies reporting positive revenue surprises. And if that 80%, by the way, on the EPS surprises ends up being the final number, that would be the highest since FactSet kept records, which started in about 2008. So it'd be a 10-year high and the highest of the records that they currently have. So that's pretty strong. Lastly, we have forward guidance on the earnings, and that's really the one small negative so far that we get, has been the forward guidance. Of those companies that have reported, 48% have issued forward guidance, and only 17 have issued positive forward guidance. Now again, the blended earnings growth rate so far is at about 20.4%. That's the second highest since the third quarter of 2010, and the highest since the third quarter of 2010 was the last quarter, first quarter of 2018. So 2 positive quarters above 20% blended earnings growth rate. If this were to remain with another, again, 19% of the companies left to report, if that stayed the same, that'd be 2 positive blended earnings growth rates above 20%. That's pretty strong. Only negative being so far that forward guidance. Now, equity markets are higher, but that may not be enough, even though the earnings have been strong. So earnings may not be enough to continually push the stock market higher if we continue to get some of the headwinds that stocks are rallying into currently, which includes President Trump saying he has the upper hand in the trade war with China, and China responding by saying that they are ready for a protracted trade war, and their populace is actually willing to take some pain to win this war. I'm paraphrasing, but that's essentially what they said. And then on top of that, crude oil prices rallying higher, potentially rates going higher, with Jamie Dimon, who's the CEO and chairman of JP Morgan Chase, a few months ago, making some headlines saying the 10-year note was going to 4%. Well, this morning he made headlines, the 10-year note going to 5%, according to Jamie Dimon. He says it could get there this year. And then continued Fed rate hikes. We've got a 93% chance as of Friday of a rate hike in September, and the market has rallied up to over a 66% chance of that 4th rate hike for 2018 happening in December. So we're starting to price in those rate hikes as well. So all of these are headwinds to the equity markets, and some people might say that we've reached peak earnings, although there is a study out there that says the market rallies 70% of the time, even once earnings start to decline. So there's a lot of headwinds, there's some tailwinds. Earnings have been decidedly strong. The forward guidance is a little bit lower. With some positive news, you could see this continue to rally up. S&P rallied today on low volume, about 39 basis points by the end of the day. This is Bob Iacchino talking S&P futures from the CME Group trading floor in Chicago.